Hello everyone. I wanted to make a video that I think could help some of you guys out with understanding what's going on at the gas pump, what's going on in your job, what's going on with your wage, what's going on with supply chains, what's going on with inflation, what's going on with demographics and the dollar empire and your 401k and all that shit. In 20 minutes or less, one take, make this as condensed and digestible and palatable as possible. I'm going to start by taking us back in time. I'm going to bring us forward into the present, and then I'm going to discuss the future. Because I don't think we can start even in 2008 here. We can go back as far as we want. Like, they chart interest rates in Babylon back 5,000 years, but we're going to start in World War II. I think that's the best place to start. And I know you're thinking, like, dude, just start in 2008, it'd make it so much easier. Start like 2 years ago, but I think going back to World War II would help you kind of get a full picture of what's going on. 100,000 foot level, this is my macroeconomic framework. All right, let's get into it. So in 1944, World War II is pretty much at like the high water mark. America's starting to get really heavily involved in the war. We called all of our allies into a room in Bretton Woods, Connecticut, in a hotel. I think it's called the Bretton Woods Hotel in Connecticut, so there you go. We called everybody into a room in 1944, and we're like, look, we're about to get really involved in this war, and if we win this war, it's going to be because of us, and here's the terms. And it was essentially, our allies were able to keep their sovereignty, conduct trade amongst each other. Like, it was a pretty good deal. All we got out of it was we get to be top dog with a monopoly on the use of physical force. We get to keep the trade lanes open. We get to be like the top of the Ponzi. They signed that agreement before they left that hotel, all of our allies. Fast forward to the end of World War II, we won. We get to execute the terms of our agreement. The world's a smoldering crater. Our institutions are better positioned than ever before. And we start to see this unprecedented growth in human population. I think following World War II, global human population grew by 20 or 40% in just a matter of a few decades. And this wasn't just an American phenomenon either, this was a global phenomenon. So imagine a situation where we just won World War II, we won the game of Risk, if you've ever played that board game. We have the board set up exactly how we want. Our institutions are strong, everybody else's institutions are weak. We have the trade lanes, we have everything we wanted. Fast forward to the 60s, we're trying to stop communist expansion, and we're trying to also promote a lot of a really big domestic agenda as far as like social welfare programs, lifting people out of poverty, the civil rights movement, all that. So guns and butter. We were trying to have our guns to fight the war in Vietnam. We were trying to have our butter back home, make America, better than ever before. All good, but one problem. Under the Bretton Woods system post-World War II, we're on a gold standard. So if the government doesn't have the money, they can't spend it. Well, we started to spend it anyway. And France was the first to ask for their gold back. So now it's, late 60s, early 70s. We're on a gold standard. All these other countries' institutions want to hold dollars. We're the top dog. You can convert your dollars to gold instantly. But then France starts to have doubts, and they're like, dude, we want our gold back. Take these dollars. We don't think you're good for them. We think you're spending more dollars than you have gold. This set off a chain reaction, and next thing you know, in 1971, Nixon has to temporarily, right? Here we are 50 years later, temporarily suspend the dollar's convertibility to gold. Immediately following that, in 71, we had a lot of inflation and a lot of stagflation. Stagflation is low economic growth, high inflation, nasty combination. So basically you have a situation where your economy isn't really growing and prices keep rising, like double whammy. A lot of people will say that this is from the Saudi oil crisis in 1973, and the textbooks will say that, but in my opinion, it was defaulting on the gold standard in 1971. So gold and silver immediately in the years following goes into like this Bitcoin type bubble. People started buying gas locks for their car. People were siphoning gasoline out of tanks in the 70s. It's crazy. You might have thought by 79, like the dollar is really about to collapse. I mean, gold's like up there, 850 an ounce. Like this is it. In a lot of ways, it would seem like that, but actually something weird happened. In 1980, 1981, interest rates peaked, and interest rates began to come down. Asset prices kind of started to go back up, and inflation became somewhat tame. So at that very moment in 79, 10 years following defaulting on the gold standard, you thought that would have been the end, but that was really the beginning of a 40-year bond bubble that we're still in right now. So interest rates peaked in 81 and have been falling for about 40 years. Fast forward to the 80s and 90s, you find yourself in a situation where now we're outsourcing our means of production to emerging markets. You might be like, well, this is free market, that's free trade. But the reality is we were sending our means of production overseas in order to have the products made and then shipped back and then sold in America. That's not free market, that's not free trade, that's labor arbitrage. If American companies wanted to go to China, produce products in China and sell products in China, hey, I don't have a problem with that. But if you're going to China to create the products, ship them back to the US, and all you're doing with the people in China is exploiting cheap labor, that's labor arbitrage. And you might be thinking, well, that's a really good deal because we can give all these other countries our toilet paper and they'll give us labor, goods, and services. And you're right, that is like a pretty good deal. Until the Chinese are making the shoes, we don't have shoes, we can't buy the shoes, they don't sell the shoes to us, and they wear the shoes. Does that make sense? They own the farm, they own the means of production. If they can't find an American buyer, they'll find a buyer from somebody else, and if they can't find a buyer out of somebody else, they'll just wear the shoes. They'll just consume the products they're creating, and we'll be left with nothing. So by the 80s and 90s, we're doing this. We're outsourcing all of our means of production to other countries. We also have Alan Greenspan starting to get involved in the Federal Reserve and the Treasury and trying to negate the business cycle. So the way the business cycle works is like real down and dirty. You have about 6 to 9 years on average of expansion, followed by 2 to 4 years of recession or contraction, and then you just rinse and repeat. Alan Greenspan got it in his head that he could start to negate the business cycle. If things started to turn down, he could use monetary policy with the Fed and the Treasury in order to reinflate things, and he was right. The problem is, fast forward to 2008, when the housing bubble burst, Ben Bernanke, the chairman of the Federal Reserve at the time, had all the tools in his toolbox to just create a centrally controlled authoritarian economy and launch quantitative easing 1, 2, 3, 4, Operation Twist, all this financial engineering and easy monetary policy. If you thought that the dollar was going to collapse in the 70s following the defaulting on the gold standard in 71, and it didn't, then surely you would have thought the dollar would have collapsed in 2008 when the housing bubble burst, the global economy started to buckle, and we started to print tons of fake dollars and just threw the dollar in the kitchen sink at the economy. There was a little bit of inflation, but you'd be surprised. Because of automation and AI and demographics, like boomers peaked in spending around 2010, we're actually able to take a lot of that fake money that we printed for 2008 and export it down the fiat global Ponzi. We were able to export it to other countries and just kind of keep the dollar empire alive, keep everything going, and keep inflation from hitting the domestic economy and consumer goods like, cereal and milk. So we're in a situation 2008 to 2015 where we're coming out of the crisis, we're printing all this fake money, and it's really not creating the inflation that a lot of people thought it would. This gets the Fed and the Treasury pretty comfortable with just leaving interest rates really low following 2008. All of this inflation that you're experiencing this last couple of years is because in 2015, we didn't normalize the dollar. After 2008, especially 7 years after 2008 and 2015, when interest rates were still zero, you were supposed to start raising, the Fed and the Treasury were supposed to start raising their benchmark rate back up to a normal level. Maybe not 21% like in 1981, but 7 or 8%, give the dollar enough value to promote savings so people will want that 7% yield on their savings account. and kind of keep asset prices in check because you're keeping a sturdy floor under the dollar. Asset prices really go up, gold, silver, stocks, bonds, real estate, all that shit, when the dollar's going down. So in 2008, everything was buckling. QE 1, 2, 3, 4, prop everything back up. You might think, well, that's going to create a ton of inflation. It didn't. But now it's 2015, and the Fed needs to start raising interest rates, and they didn't. They were like, dude, we can keep interest rates really low. We can have our cake and eat it too, and we're never really going to experience the inflation we thought we would, so just leave it low and protect the financial system. Well, we played that game from 2015 to 2019, which is really weird because in 2019, there was no virus, there was no recession. We were 11 years into an expansion. And the Fed and the Treasury abandons their rate hike policy at 1.25% interest, and they start cutting again. So they never got back to the 7% needed in order to get ready for the next recession. They cut from like 1.25% in 2019. So basically the dollar following 2008 was already really weak, really off balance, was in a very abnormal state. Yellen's words, not mine. And they never fixed the problem. And then in 2015, they're way overdue to really need to, get the dollar normalized, and they still don't fix the problem. So then in 2019, instead of really fixing the problem and getting the interest rate up there, because now they're super behind, they start cutting. They cut. Next thing you know, a virus hits a few months later. Now all bets are off. Interest rates are not going to be going back up. They're going to be going lower. We're going to be printing tons of fake money. This should send asset prices higher and the dollar lower. Well, what happened in 2020? Elon Musk went out and bought a bunch of Tesla shares, SpaceX shares, and Dogecoin. Warren Buffett bought 50 million shares of Chevron stock. Bill Gates bought all the farmland. Jeff Bezos is like going into Blue Origin and like all this high growth tech crap. None of them wanted to hold dollars because they knew the crash wasn't going to be in the dollar, or wasn't going to be in markets. They knew the crash was going to be in the dollar. So in 2020, right when everything got scary and started to buckle and people thought, oh my gosh, cash out, sell everything and hide under the rock with the cash, that wasn't the move. All the elites went out, did the polar opposite. Cash was trash. They borrowed tons of cash that wasn't there, and they bought things that would go up. That was the move. But now you're in a situation where the dollar's pathological, interest rates are never going up again, asset prices are hyperinflating, the elites keep borrowing fake money that isn't theirs and buying assets, making them go up more, and the dude making like $11, $12, $15, $17, $20 an hour, he's jammed up, he's screwed. He has no social upward mobility anymore. Because over that same period, over this whole framework I presented to you, wages didn't go up with the cost of capital and asset prices. In 1970, you could have worked 35 hours at minimum wage, which was like $1.25, and you could have bought an ounce of gold. Today, that same ounce of gold's worth $2,000, and minimum wage is probably paying you $500 a week. So put another way, wages have fallen 5x against asset prices since we defaulted on the gold standard in 1971. So now we're in a position where we're hitting a demographic wall. Boomer spending peaked in 2010. It's a massive, massive cohort. They're hitting retirement age. They're putting nothing into GDP. They need their $2 million nest egg to get inflated to $4 million. They know they're not going to have the growth to do it, but they know they're going to need to print the difference. All of our institutions, the retirement, the pensions, the 401ks, it's all the B system. It's all a Ponzi that has to be protected at all costs. So if the B system has an embedded growth obligation established by this like post-World War II, post-Vietnam kind of paradigm the boomers kind of built, if we have this embedded growth obligation, but we're not meeting our, we're not having our growth needs met, you would think, oh, well, that's going to translate to crashes in markets, like instability, asset prices coming down. That's not what happens, because they'll just print the difference. So the economy needs a certain amount of growth that it's not getting, but the B system, the 401ks, the pensions, the retirement system, all that, it will get it hell or high water. The Fed and the Treasury will negate the business. They'll do anything they have to do to make sure the embedded growth obligations continue to be met. even if it means fake money, pathological institutions, and liars leading you. And that's kind of the situation we're in now. Bad demographics, embedded growth obligations, a monetary system that was not normalized post-2008. It was supposed to be normalized in 2015. They never got around to it. In 2019, they started doing even more cocaine when they were supposed to really be getting ready for the next recession. Then the recession hits, and then they throw the kitchen sink once again at the markets. They throw the dollar in the kitchen sink at the markets to keep them inflated. So you could have worked for like 35 hours of work in 1970 at minimum wage, got an ounce of gold. Today, you're barely getting $500. An ounce of gold's $2,000. And there's no end in sight. You're hearing right now, oh, well, don't worry, they're going to raise interest rates now. Like, they didn't raise them in 2015 where they were supposed to. They didn't raise them in 2019. And frankly, they should have raised them even during the crisis, because when you raise interest rates, you're drawing liquidity out of the system. But there were also half as many goods and services in the economy. So if you have a situation where there's half as many goods and services from a shutdown and a virus, and then half as much liquidity, that means the same amount of dollars essentially are chasing the same amount of goods and services. That would have kept prices stable. But what did they do? They took the interest rate down. They printed 40% of the money supply in like 2 years. It found its way into asset prices. And now you're saying, dang, the dollars I'm working for are falling exponentially faster while I'm running and working exponentially harder. It's the road to serfdom. The harder you work, the faster the currency falls. And you take that currency and you try to get it into assets, but you can't quick enough, especially if you're like a young person. So we just hit a demographic wall. All the old people are holding all the chips and the gold coins, sitting on them like a dragon. They know they can't let interest rates go up and normalize the dollar because that would crash their retirements, and they're putting nothing in. But they know they can't lower interest rates anymore without stoking even more inflation. So the Fed's stuck between a rock and a hard place, people like to say, but it's actually more complex than that. The Fed's not behind the curve in normalizing interest rates. The Fed is the curve. And this is all engineered and by design. Today, the Treasury Secretary goes on TV, Janet Yellen, she says, oh, well, I didn't know it was going to create all this inflation. Yeah. Warren Buffett knew, Bill Gates knew, Elon Musk knew, I knew, but you didn't. You and your 850 PhD economists had no idea that if you added 40% to the money supply, it'd create 40% inflation in 2 years. Are you kidding me? Of course they knew. It was completely engineered. They're not behind the curve, they are the curve. Inflation is their biggest cash cow. I mean, imagine if you have $30 trillion in debt. Do you want to, and you can't pay it off. Do you want to let interest rates go up so now you need trillions of dollars just to keep your credit card going? Or do you want to keep interest rates really low and if you can, even destroy the value of the $30 trillion debt so you only owe back 15? This is basically countries default one of two ways. You can either say, hey, I got a $30 trillion debt, I'm never going to be able to pay it off, can't have, don't pay, the whole system deflates and crashes. That's what a normal person would have to do, but governments don't do that. They say, what do I owe you? They say, oh, the IRS is bringing in this much tax revenue, we have these liabilities that need to be met, we can't meet them, print the difference, write the check, write the bad check, who cares? And that's really what quantitative easing is. I mean, it's the Treasury saying to the Fed, give us a ton of cash and we'll give you a ton of bonds, and then you can sell those bonds later once the storm blows over. Thing is, they never sell. The Fed will give the Treasury the cash, which is printed out of thin air. The Fed will throw the Treasury's bonds on their balance sheet and never sell them. It's like having your cake and eat it too. So you're in a situation where the demographics are bad. You can't really find a good job because they've outsourced the manufacturing jobs to other countries. Asset prices are in the nosebleed from 22 years of suppressed interest rates, but they can't raise interest rates because it would crash that, and a bunch of people just retired and can't afford a crash. But you can't lower interest rates because you're just going to make inflation worse. So that's why you're not really seeing anything that makes sense. And, and people are trying to say, oh, it's supply chains or it's this, that, but you see how I put it all together, and you can kind of build a framework for how we were jammed up before and got jammed up now.